So let's start with a kind of a wild question. Can the moon, that giant rock up there, actually move the stock market? I know, it sounds absurd, right? A little bit like folklore. But what if there's a genuine, data-backed connection? That's the fascinating and frankly weird possibility we're going to dig into.
Believe it or not, that's Shakespeare, writing over 400 years ago. This idea that the moon can mess with our moods and behavior, it's not new at all. It's actually baked into our language with words like lunacy. But some people take it way further, into a field they call financial astrology, and they believe this lunar influence reaches all the way to Wall Street.
Okay, so obviously the first reaction anyone has to linking stars with stocks is, well, a healthy dose of skepticism. But it's right there, in that tension between our disbelief and some pretty surprising data, that things get really, really interesting. And this right here just captures that conflict perfectly. On the one hand, you have a book with this bold title promising to help you forecast market cycles using the planets. But then you flip to the fine print, and you get the legal disclaimer that basically says, hey, just so you know, this might not work at all, and if you lose your shirt, that's on you. It's this system of belief just crashing right into the cold, hard reality of financial risk. So what are we really talking about here? Well, financial astrology is exactly what it sounds like. It's the practice of linking the movements of planets, moons, and stars to what's happening in the financial markets. Now, this whole idea is completely at odds with standard financial theory, things like the efficient market hypothesis, but even so, it has this surprisingly long history with some very dedicated followers. All right, it's easy to dismiss this as pseudoscience. I get it. But what happens when serious academics, we're talking researchers at major institutions, decide to just run the numbers on a global scale? Well, this is where our story takes a very unexpected turn. This was the exact question researchers posed in a paper for the London School of Economics. See, they weren't interested in belief or theories or any of that. They just wanted to know one thing. Is there a real, statistically significant correlation in the historical data? And the answer they found was this. On an annualized basis, the difference in stock returns between new moon and full moon periods was between 3 and 5%. Let me be really clear here. Across 48 countries, returns were consistently lower around the full moon. It's a baffling, statistically significant finding that's really hard to ignore. You can see it right here in the data. The chart shows it plain as day. Average daily returns are consistently higher during the new moon phase, and then they take a noticeable dip around the full moon. It's a strange pattern for sure, but a persistent one that they found across global markets. So here's the crucial part. The researchers tried everything to explain this away. They thought, okay, is it a day of the week thing, the January effect? Is it tied to big economic news? Nope, nope, and nope. The correlation just stuck around. And here's the most telling clue. They found the effect was even stronger in small cap stocks, the kinds of stocks held more by individual investors, not big institutions. This suggests that if the effect is real, it might have its roots in plain old human mood and psychology. So, it's one thing for academics to find a weird correlation in a spreadsheet. It's another thing entirely for actual traders to build entire investment systems around it. And these folks aren't just glancing at the moon. They're creating these incredibly complex models based on celestial mechanics. Take W.D. Gann, for example, a legendary trader from the early 1900s. He developed these methods based on what he called time cycles. The process was pretty straightforward. You find a major market turning point, a big high or a low. Then you just count forward a specific number of days, and you watch those future dates as potential pivot points. It was this really systematic attempt to map time onto price. And here's another one. Donald Bradley's cytograph from the 1940s. This model basically turns astrology into a mathematical index. It assigns a numerical score to different planetary alignments. So what astrologers call a trine is seen as harmonious and gets a plus score. A square is seen as tense, so it gets a negative score. The model then just adds up all the celestial pluses and minuses for a given day to create a single forecast line. Okay, so we have this strange data and we have these surprisingly complex systems. But what is really going on here? Well, to understand that, we need to zoom out a bit and look at financial astrology's more mainstream, though still pretty debated cousin, technical analysis. And when you put them side by side like this, the parallel becomes crystal clear. On the left, you've got the jargon of astrology, lunar cycles, planetary aspects. On the right, you've got the jargon of technical analysis, with its death crosses and Fibonacci retracements. You know, one sounds mystical, the other sounds mathematical. But really, they're both just systems designed to find predictive patterns in what looks like total chaos. You could argue they're serving the exact same psychological need. And this quote just hits the nail on the head. When things feel uncertain, whether it's in our lives or in the markets, our brains desperately crave order and predictability. We hunt for patterns. For some people, that's a horoscope. For a trader staring at a screen, it might be a 200-day moving average or a chart pattern. Both offer a sense of control, a story to make sense of all the noise. So after going down this rabbit hole, exploring the data, the tools, the psychology, where does this all leave us? What should we really take away from this little journey into one of the strangest corners of finance? Ultimately, you can look at this in three ways. First, you can see it as just a puzzle in the data, a documented statistical correlation that conventional finance just can't explain. Second, you could see it as a set of unconventional tools that some traders use to build strategies. And third, and this is maybe the most compelling view, you could see it as a window into investor psychology, in our deep, deep need to find patterns in the noise. And that brings us to our final big question. We love to think that markets are rational, that they're driven by earnings reports and economic fundamentals. But what if they're also driven by fear and hope and that ancient human impulse to look for a story, any story, in the middle of chaos? What if, sometimes, the map we draw becomes more important than the territory itself? That's something to think about.